All right, the long-awaited FOMC meeting finally happened today. At least the statement finally came out today at the end of their two-day meeting. And we got a 50 basis point hike. Widely expected. That was not on the table, though, at the last FOMC meeting. And the market rallied because of that. Remember, the market actually started an intermediate run after the last FOMC meeting because of a dovish response, because of a dovish statement. Well, seems like the market's following a very similar pattern. So we're going to break that down and show you the pattern of this current market move compared to the technical environment that was set up before we even had it, because we were already expecting some bullishness because of the bearish patterns, the bearish oversold technical patterns we were already seeing. And then when you look at the other two meetings and how the markets reacted positively both times, not surprising that we got the kind of move that we did today. In fact, a lot of you probably were expecting that based on what you've been hearing in the last so many market outlooks from me. When we've been pretty bearish over the past week, well below short-term moving averages, which usually sets us up for moves back towards those moving averages. So I'm going to break that down. We're going to break down all these different asset classes, the dollar and bonds, and how they responded to today's statement and press conference. Then our trade idea is a stock in this beleaguered home building sector, and talk about how to trade a reversal pattern that we're seeing there. So let's go ahead and get started. All right, today is Wednesday, May the 4th, 2022. This is the market outlook from marketscholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator, and look at that. Look at that rally we had, getting it back above the 23% retracement, this long-term 23% retracement right there. So we had 3 days below it, like we talked about before. We got back up above it. We also got above that 23% retracement level of this market sentiment run that we're on to the downside. And then, of course, there's that intermediate rally. Actually, we have to change it because that's the intermediate rally that we were retracing. Let's see here. Let's change this to the intermediate run that to the downside, the leg lower that we're on now. So you see we're above the 38% retracement there of that line. So pretty good move, getting up to pretty much the highs that we saw last week there before we had Friday's decline. So basically where we were Thursday, inside of the range, close to Thursday's high. I mean, look how much we rallied. The near-term line got into bullish territory, did not get to strong levels yet. Barring a big collapse tomorrow, you're very likely going to get the near-term line up at least above 80, if not above 90, similar to over here. Right? This was, again, the 16th right there. This day is when the Fed, the last FOMC meeting right there, where they raised 25 basis points. They were not going to raise 50 basis points here. They were only going to raise 25. So the market had brought its expectations down from 50 to 25 on that meeting. Sounds very familiar, doesn't it? So the market rallied the dovish Fed, and guess what happened today? 50 basis point hike. Now they're dialing back the expectations for a 75 basis point hike in June because it's not on the table, right? But remember, they said that the 50 basis point hike wasn't on the table here on the 16th, and that's what led to that rally. This is the 25th, the 26th, excuse me. That was the day of the FOMC meeting there, and look at the rally we got coming off of this low. We were 6% below. We were however percent below here, 6% below close, and over here we're 6-7% below. The market dropped ahead of all those FOMC meetings, and the market's now rallying out of every single FOMC. This is not surprising in the least bit. Of course, you're going to have some resistance right here, about 43.50, right at that 50% retracement, which is sitting on top of that 38% retracement of this. And then I would venture to guess that you'll probably get a little bit more of resistance up here right around 44.50, a little bit below that in that area, with that 62%. The 30-day moving average will be there, the 62%, that long-term 50, and probably a little bit up closer to that area, that 678 and 62. Getting above that now changes the impulse move, right? Because you've got resistance on the market sentiment, and then you get the 78% line there. So you get above 4,500, and you're changing the impulse move. So unlikely we'll get there, but obviously nothing's out of the realm of possibility. That's the S&P 500. The NASDAQ, you can see, again, the intermediate line is still below market sentiment. but a good strong short-term sentiment we haven't seen for a while, not trend changing. We're still 4% below the moving average on the NASDAQ. And then the Russell 2000, you can see similar, right? If I were to change this, activate this, do the same thing we did on the S&P, since we're on a bearish run to the downside right now, you can see we're sitting right at resistance on that 38% retracement. That market sentiment line, we need to change that one now, since we're continuing to move down here. So we'll move this up to that level, move this down to that low. So there's your market sentiment line. So you can see we still have about right up to about 1985 before we start to retrace that market sentiment run, right, with a new intermediate run, a new intermediate leg to the upside. So the S&P, remember, has already broken above that 23% line. And then if you look at the NASDAQ, I don't think I must have taken those off on the NASDAQ, but let's draw those back on there. So here's the market sentiment decline to the downside here. So make sure we color that one orange so it stands out for the market sentiment run. And then here's our current intermediate drop that we're on right now. You can see a lot of those lines sitting right on top of each other. Oops. Cancel. And let's get this one green for the current intermediate run that we're on right now. Okay, so you can see there's some resistance there, 13,700, 23% retracement that we haven't broken above yet. Again, like we have on the S&P, but we just haven't on the NASDAQ or the Russell yet. Once we do, then we'll be on a new intermediate leg. I don't think the intermediate line on this one gets above 80 again. We'll probably get up above 50, maybe right around 50. Maybe get, again, light pink shading or light green shading and yellow line, but that's probably going to be it for the extent of this current rally that we're on. That's a big move to the upside. We've been talking about that we're going to get, we got a 3% drop. You're going to get a 2-3% rally coming out of it. Surprise, we got a 3% rally today, right? I think the only people who are surprised by this are people that don't pay attention, right? That just think that when markets are bearish, we get nothing but red bars here. And we all know that that's not the case, right? Every time you get a big red bar to the downside, within a day or two, or in this case 3, you're going to get a big bar to the upside. That's just the way it is, right? And you can see, just like it did over here, here's that March meeting, the implied volatility dropped below historical. There's the January meeting, implied volatility dropped below historical. Implied volatility is dropping below historical. There's precedent. Every FOMC meeting, there's precedent for the markets to rally coming out of it, because the markets are pricing in a rate hike, 25 in March, 50 now, and the market's eventually most likely going to get back up to 75 by the time all is said and done for the June meeting. It was 100% probabilities of a 75 basis point hike before today's meeting. Don't be surprised, like the 50 basis point, that we get right back up to it within a week. I would venture to guess within a week, the odds for a 75 basis point hike will be right back there. Depends, I guess, on when we get the economic data that builds those expectations. Let's take a look at the long-term. Oh, I wanted to show you this chart too. Let's take a look at this chart first. So here's the candle. You still don't have a upper shadow yet. 4308, you're at 4300, so you're really close to getting an upper shadow, which will be trend changing. The PPO is still bearish. We still got the red arrow, so we haven't turned things around there. The Russell hasn't either. The NASDAQ hasn't either, and the Russell hasn't either. Let's take a quick look at the whole. I wanted to show you that. Again, this is going to be fascinating. So here's go SPX. So look at that green bar. That's the January 25th. There's January 25th right there. So right in here. So there 26th, 25th, 26th. There's the meeting. And look, the market rallied coming out of the meeting. Here's March 16th right there. And look, the market rallied coming out of that meeting. Rallied more, but it rallied. And guess what? You got a bullish candle. You got the parabolic star flipping to the downside. You don't have the green line yet, but you will within a day or two. You're pretty far up above. You can see that you're, from a 200-day perspective, you're above the moving average. Last time we had green bars, that was the March meeting, and then there's your January meeting, right? That's This is there's a lot of precedent to this. Not very surprising at all, the type of market. But is this enough of a move to change us to change the trend to the upside? And so we look at like the McClellan oscillator. Obviously, you're still negative on the summation index, so we're nowhere near turning things around there. It's got to get positive at the very least. It's got to get above 500 to really solidify a new bullish trend. So obviously, we're not there. The other thing we need to see is the actual oscillator itself to get up to relatively high levels. 15 is not a high level. It's a really good bullish day. 15 is not a high level yet. Now it's going to start small, and we'll see how big it gets. But if we're going to really start a good bullish trend to the upside, coming off of a significant low point, correction low point, then you got to get up to like above 100. So let's see what ends up happening from that perspective. Let's take a look at the 3 green arrows. We obviously now do not have 3 red arrows anymore because we have a green arrow on the stochastics. Remember, we talked about that would be the first one. You got 2 on the Qs and the Russell, and then 1 on the diamonds. So we got no shading. Now the question is, what if and when we'll get green? We'll probably, we might get green tomorrow. If we get 3 green arrows tomorrow, we might get green. The question will be whether or not we stay green and have an intermediate run, or whether we just have a one-off green like these, and we just turn right back down to being bearish again. So we're not even to the green part yet, but that's something we need to be watching really closely. The other thing we watch closely to see here in terms of a trending move to the upside is for the MACD to be positive, which it almost is, just about is, and for the price to be above the 17-day moving average. So we're pretty close, but look at all that resistance above. Like we talked about that 62% retracement, we talked about that 38. I mean, look at all the volume that's sitting right at those levels. It's going to be hard, not impossible, because you can see we pushed through over there, but it's going to be hard to push through that. You expect resistance to hold until it doesn't, right? And then now, so you can see we did get above the 17-day on the S&P. We did not get above it on the Qs, and we did not get above it, on IWM, but just right at it. But you can again see, look at all the resistance that you have here. Let me move this down again. Move this up here. So there's the intermediate run we're on, and then let's get this market sentiment line down to this low point 2. So look at, there's that 23% retracement. It's also lining up 50% on this intermediate rally. A tremendous amount of volume at that level that you'd have to break through to get going. So we're not, again, not necessarily a bullish breakout here, but in fact we're not even not bearish anymore. The DMI is still above 25, positive is above 20. That's a good sign. But the DMI, the negative, is still easily above 25. The smidgen below 25 in IWM, but the positive is not above 20 are in the Qs, and the same thing for IWM, right? So again, we're just not as bearish anymore. You look at the trend strength indicators, we had a really good trend going. It looks like we're probably going to end that. We're not above the blue line, much less the cloud. And you remember, it's really important about where we're going to be with that green when we get to the green shading. Because if we're still below that green shading when we get to it, then it's going to be like this, right? By the time you get to the pink shading, you're above it, you're still bullish. By the time you get to the green shading, if you're still below it, you're still bearish. That's the SPY. The Qs aren't even close to the shading, and neither is IWM, and they still have strong trends going. But at least in this case, the RSI and the CCI, they're in neutral levels, not bullish but not bearish either, right? We're not below 40 anymore, but we're not up above 60, which is what it takes to get out into bullish territory. And then finally, looking at the Bollinger Bands, and let's look at it with the Keltner channels, so we can look at them together. So we have been trading between. Remember, we talked about that's trending. We got a pretty good peak on the Bollinger Bands. You got the bands are outside the Keltner channels. You got the green dots, but you got the yellow bars now, which means we're probably going to move back towards the middle at least the middle of the Bollinger Bandwidth, if not briefly into. Remember, for the trend to change, you got to get above 100. See, we didn't get above 100 there. The trend never changed. So you got it, and it never really changed on any of these. But when you got the trend to the downside, we did a break down to the downside and broke the bands. In fact, The one day we got above the Kelvin channel on this rally was the peak, right? Was the peak. In fact, that was a cluster on multiple indexes. So the other thing that we really missed today, if we're going to really be bullish, is some kind of gap, right? Some kind of runaway, breakaway gap that we won't fill in. So we don't have that. In fact, we're sitting right at last week's high. Now there's going to be an important break there. If we break through this 430 level, we can get up to 437. That's where the next layer of resistance is from a volume standpoint. No gap here either, and you can see where the resistance is in the volume on the Qs, and the same thing with IWM. There's a pretty significant resistance on a short-term basis above where we're at right now. So we just ran so much right now so far that we probably made most of this move already in one day. Probably a little bit more to come. Probably by the end of the week, we might get another day or two of rally, but then I wouldn't expect a whole lot more than that, right? I think we'll get to the 17-day moving average. Maybe, I think we'll get to, look how close you are to the 50 or 30. I don't think you're going to get through those levels, especially with all that long-term and short-term volume sitting right there at those spots. And the other factor too is that volatility is already pretty darn low. That's for volatility just in one day to go from being above, or 2 days, to go from being above 100% to being at 90, just like that. And remember, we haven't washed out yet. The VIX never did get to 125%, which is where it needs to get to really wash out. The skew never really did drop to extreme lows to really wash out to the downside. Let's update this, and let's just go back to the 1 year chart. We're down at 127, but that's what we got down to over there. So we really haven't washed out and broken back up above, getting the skew back above that moving average. That's when things turn back around to the upside. And we're not. You can see on all of these, when the skew gets back above that average, then we start moving up. We're still pretty down below the average. And you can see, we kind of had that here too. We stayed below the average, we made another leg lower. So really important to watch that skew get back up again with the idea that now we're being bullish. One thing I tweeted out was on this rally here, on this drop going into the, what would that be, the March FOMC meeting, the dark pool, and really for that matter going into the January meeting too, the dark pool index was really high. Like there was a lot of dark pool buying here. Let me refresh this so it updates it for today. There's a lot of dark pool buying here. There's been a little bit more today, but not nearly to the extent that we saw ahead of both these other meetings. So, it's high. It's relatively high compared to what we see over here, but not as high as what we've seen. So I don't expect we'll be as bullish, right? We didn't have a lot of that dark pool buying coming into it. And you can see, already there's a pretty decent level of gamma exposure already. We're not quite to these levels. And again, this is all relative. We're way low compared to these, but compared to where we've been, it's a pretty decently high level of gamma exposure. In other words, it seems like a lot of, the markets are really bullish today, and you wonder how much of the bullishness going forward, because of a dovish reaction to the FOMC, has been pulled forward into one day today. The TV media personalities were just falling over themselves about how bullish the markets were. It's like, haven't you ever seen this before? Like, we just had 2 runs just like this the last 2 meetings. Like, how surprised could we be on a day like this, especially when we were so bearish, even just without an FOMC meeting. We've been talking about that we are so far below these moving averages, we're going to get big moves. Every time there's a big drop, there's going to be a big move back up to those short-term moving averages. So even without the FOMC meeting, it should have been surprising that we had a 2-3% rally. But then you put on the fact that the FOMC came out and the precedent has been a rally coming out of it, it's not a surprise. And there's a little bit left, right? There's a little bit of upside left. Until we meet up with some resistance. And again, you expect resistance to hold until it doesn't, and if it doesn't, then we'll revisit and see what we've got. But that's kind of what I expect over the next few days going into early part of next week. What do you think? Do you agree with that? Do you disagree? And let me know in the comment section below, especially if you disagree. Tell me what charts or indicators are you looking at that tell you why you're either a lot more bullish than I am or a lot more bearish than I am. Alright, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video. If you're watching us on YouTube, that notifies you when our videos are posted. Also, while you're down there, hit that thumbs up icon. That tells us two things. One, you liked our video today. And two, you want us to do another video again tomorrow. It's a quick way to give us feedback if you like our stuff. Of course, if you don't like it, you don't have to click anything. Also, right down there, comment. What stood out to you from today's video? What questions or comments do you have? Post those in the comment section below. Join our website at marketscholars.com. There's a link popping out in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content between the videos from day to day. There's my handle at DavidSettle42, and join our Market Outlook Facebook group that we've created. If you're watching this here on the blog, check out some of these things over here on the right. Click on this icon that takes you to our Market Outlook live page. On Monday, Wednesday, and Friday at 3:30 Eastern Time, I do a quick little live video here on this page, about 10-15 minutes long. We take a look at trades we've put on previous Market Outlook videos to see whether we should stay in them or get out of them. We actually got out of some today. Of prior trades that we put on. We talked about why and how and all of that. We also put on today's trade idea already before the market closed. We did that during that live video as well, so you can check that out as well as the old archives there if you have any days in particular you wanted to look at. You can also get to it up here in our main menu by clicking on Live Trade Review. Come down here, you can see our upcoming classes. Click on View More to see the full calendar of upcoming classes and then also 4 years worth of recordings. Come down here, click on that heart. It takes you to that tab. Hit that like button. Same thing with this thumbs up icon. Click on that. Takes you to this tab, hit that like button. Again, the more you do that, it helps get our content out to more of our followers. That's been one of our biggest reaches that we've had in a long time because of the engagements we've had. So keep liking those and commenting, sharing, both on Facebook and Twitter. It really helps us out by getting our content out to more of our followers. Really easy. You can do it right now while you're watching. It also helps you out because Twitter and Facebook promote content in your timelines from the accounts you engage with the most. We try to make it really easy for you to engage with us right here. All right, now let's take a look at what's driving the price action today. Of course, we know what drove the price action today. But what's interesting is look how strong commodities were going into the FOMC meeting. So by the time the FOMC meeting came out, commodities were already up 2.5% and real estate was down 1%. Emerging markets were down. You can see at the beginning of the day, the Qs were down 1.5%. Small cap stocks were down 1.25%. Emerging markets were down 1.5%. It was kind of an equity sell-off. And then you had the rally going into the FOMC. The Qs were actually up briefly right before, and then you can see the initial reaction was positive and then negative on all these equity asset classes, and then a big strong move, like I said, on the Qs, up 3.5% almost by the end of the day. S&P up 3%, IWM up 2.75%, commodities up 3%. So that everything kind of caught up to where commodities were. Bonds were positive, very small positive gain. Were down initially, so yields rallied, but then bonds rallied and dropped. Didn't rally by very much, but then dropped. You can see corporate bonds rallied. You can see emerging markets finished today positive, though lagging behind significantly, despite a very sharp drop in the dollar. When you look at, let's take a look at some of these different asset classes now. We'll look at on this chart first. Let's look at UUP. There's the big drop. Now again, this is barely below the 8-day moving average, but look at all that volume down there. And then you can see the MACD's turning, stochastic's turning down. If you look at the Euro US dollar, you can see above the 8-day moving average. Again, it's still got a long ways to go to actually get above the 17 with the MACD above, but you can see starting to get a little bit of a reversal, a big drop in the US dollar versus the yen. So the dollar itself, this big significant move to the downside here. When you look at the currency chart in comparison to the dollar, again, just looking at May the 4th. You can see initially everything was kind of up against the dollar, the only a few that were down, but look, by the end of the day, the dollar was by far the worst performing currency. The yen was also down against everyone. Remember, the yen is a safe haven currency. So the yen was down against everybody. You can see the Swiss franc, the blue one, is also down against everybody. Again, another safe haven currency. So your commodity related currencies all really rallied sharply to the upside. The Aussie, the Kiwi, even the Canadian dollar was right there with the euro, outpacing both those safe haven areas. Maybe they were Canadian dollar dragged down, and the Mexican peso for that matter, relative to some of these others, because of its strong trade relationship with the U.S. dollar. You can see, other asset classes. Bitcoin had a very strong day today. Commodities and Bitcoin, there's a Bitcoin rally. But again, not getting above the 17-day moving average yet, with the MACD above its moving average. So, we're not quite turning things around there quite yet. When you look at bonds, long-term bonds in particular, as bearish as they've been, they weren't that bullish. I mean, up 0.5%. That's not very bullish. I mean, again, not even close to getting above the 8-day, much less anything else. Now, granted, the MACD is above its moving average, and you're still well below 17. So you're on a really significant bearish convergence right now, setting up some divergences with the stochastics and the MACD, since you're already getting lower lows. In fact, when you look at, we've already looked at how extremely bullish, or how extreme the DMI was, and you're setting up divergences there on that. But you remember the RSI also hit some pretty significant levels too, getting down to well below 30, getting down to close to 20 on that first low point, and then just a smidgen below 30 on the second one. So divergences across the board setting up. And remember, long-term bonds here has been in a bear market. When you look at it on a weekly chart, in fact, let's go back. When you look at bonds on a weekly chart, this is the lowest the MACD has ever gotten on TLT. This is the biggest bear market. Even when you look at say the 17-day moving average relative to the 200-day, 200-week moving average. So when you look at that, the 17-week, the red one, is down below the 200-day further than it ever has been. In fact, when you look at some of these other times, this bear market preceded the two corrections, right? This bear market in bonds preceded the bear market or the correction of fourth quarter 2018 and the COVID drop, right? You had this big bull market in bonds that came out of that. You can see 15 and 16, right? Here's 15 and 16, the global slowdown that we saw. That didn't impact U.S. equities because of the FANG stocks, but impacted a lot of other areas of the equity market. That was preceded by a bear market, and just a smaller one, but a bear market in bonds. You can see the correction of 2011 was preceded by a small bear market in bonds. The big correction you saw in 2010, that wasn't a big, technically a correction, because we weren't above the two. We were already below the 200 week. We were never above it. So it was kind of a pullback at the very beginning of that run, because we hadn't crossed the 200 week moving average on the S&P. That was preceded by a small bear market. And of course, this 2007, at the very end, beginning of 08, end of 07, that correction that turned into a bear market in May of 08 after failing, that was preceded by a bear market, you can see here in bonds. So this is the biggest bear market in bonds that we've had. And all these corrections never turned into bear markets except for the one, and this is even a bigger correction than that. So, again, if bond prices lead equity prices, and bond prices have, pretty much in a bear market, then the expectation is that stock prices will most likely follow suit at some point in time. And remember, they're not anywhere close right now, just barely getting the 50, and look how far the 17 week is, and for that matter, again, look how far above the 200 that we currently are right now. We're still 24% above the 200 week moving average. There's still plenty. I mean, that in and of itself, if you follow the line all across the left, this level in and of itself is a pretty darn high level, right? You can see that's how high we got going into the 2007-8, that correction right there. It's about as high as we got You can see in the first quarter of 2018 when we went parabolic, that was about as high as we got. And then of course going into COVID, we were this bullish, this far above the 200 week. That's where we are right now, and you can see the stochastics, how low it is. So definitely still more, we're definitely still not necessarily correct. In fact, again, you can see on a weekly basis we crossed below the 23% last week, immediately getting back above it. It's kind of hard to be in a correction mode when you can't get below the 23% retracement of that long-term move and stay below it. Remember, the Russell 2000 is, and Russell's almost done correcting, right? It's gone all the way down. It's only less than 10% above the 200-week moving average now. Was last week it was down to, what was that, 5%, 5.08% is all we had. Now we're up to 9.87, still below its moving average. But you can see it broke the 23% earlier this year and has stayed below it this entire time. One little failure there to get back above it, but it's back below it, and now it's trying to get below 38%. So you can see that, this correction mode, it's just a matter of the S&P following where some of these other asset classes have gotten to already. Let's take a look at how the sectors move today. So let's go to the sector comparison chart and look at the one-day chart there. Oops, did not want to do 138 minutes. There we go. So you can see, again, going into the FOMC meeting, energy was already strong, ended up 4%. Interestingly enough, utilities and staples were your best performers going into the FOMC meeting, along with some of these other cyclical areas. Technology, discretionary, communication services were the weakest ones. They ended up, this communication service and technology up 3.5% and discretionary up 3%. Staples and utilities were up 2.25%. Still, and healthcare, still all these safe haven areas still doing pretty darn well considering the risk on nature of the market. When you look at the charts for all of these sectors, remember we're kind of light green shading over here and red line. That's kind of about where we're at all across the board. Energy a little bit more stronger, and actually new 3-month highs right now in energy. Nobody else is really even close to 3-month highs. Other than that sector, and that's brought energy back to a dark green shading and a green line just like that. One other area of the market that's been hit pretty hard that appears to be kind of basing is the housing sector. It's like a DR Horton for our traded the other day. You can see a nice good rally, one of the highest closes we've seen in a while. Didn't quite get above those highs, but at least closed above a lot of highs, and it's the highest close. The near-term line getting above 80 for the first time in multiple weeks. The intermediate line turning up, so you have light green shading 2% above. So not far enough above to kind of really turn things around and get going to the upside. You got light green shading and yellow line, but pretty decent day nonetheless. You're definitely not bearish anymore, right? So you got your DMI almost getting above 25 on the positive. That hasn't happened for a while. The negative is almost below 20. That hasn't happened for a while. So things are slowly shifting here. Let's look at the stochastics. You can see the stochastics for the S&P crossed above its moving average. For DR Horton, it crossed up above 80. So it's that's a really strong move, very low level for DHI. It's an opportunity to move to the upside. Looking at the R side and the CCI, you can see we are in neutral range on both of those, but at least in the upper half of the chart on both of them, if not in bullish territory yet. Looking at the trend strength indicators, that strong bullish or bearish trends weakening above the blue line. 3 red arrows too, mind you, with that as well. 3 green arrows, excuse me, 3 green arrows with average volume there. And then when you look at the Bollinger Bands, and let's look at the Bollinger Bands with the Keltner channels here. There we go. Look at DHI, you can see we are very low. The bands are way inside the Keltner channels, way inside of that. Big jump into the upper quartile of the bandwidth, not above 100 yet, which is usually what sparks a trend, but at least in the upper quartile. And we've had this momentum that's been so bearish now. It's it's about to turn bullish with some green dots. It gives us an opportunity again not to be bearish anymore, to at least be somewhat bullish. You can see the long-term chart here, the weekly chart, giving us a transition candle, multiple transition candles over the past 3 weeks, but really not really trending to the upside. So what I decided to do here was to do an iron condor spread. You can see down at the bottom, we'll come over here and sell the 67.5 by the 65 for protection, sell the 82.5 by the 85 for protection. So this is what it looks like. We did a full contract size since we just went through earnings. And you can see if I were to go to switch this, to June expiration, you can see that pretty decent probability. And my break-evens end up being for the stock. You can see where my break-evens are. My lower break-even is down below these lows, so I have opportunity for it to move down. But you also see I have opportunity to move all the way up to this shelf of volume. I've got some pretty decent volume resistance. Got a couple of touches here in this area too. So we can move up into the value area, move up towards this volume, multiple resistance levels by the time I would be hitting my break even on the upside. And then, like I said, it goes up, can hold that resistance and even come back down and move to new lows before I touch my break even on the downside. So a pretty decent setup there. Alright, well that does it for me. Now you've heard from me, I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any thread there with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on the video down below. Remember, you can also join our website at marketscholars.com for free. Follow us and like us on Twitter and Facebook. Have a great rest of your Wednesday night, everybody, and we'll see you all next time.